Europe did not collapse after the global financial crisis. The streets stayed clean, the trains kept running, the welfare state held, daily life looked stable, almost reassuring. But stability can hide a slower kind of loss. According to World Bank data summarized by Econofact, between 2008 and 2023, the European Union economy grew about 13.5%, rising from about $16.37 trillion to about $18.59 trillion. Over the same period, the United States economy grew about 87%, rising from about $14.77 trillion to about $27.72 trillion. The gap between them is now roughly $9 trillion. That divergence did not arrive with a dramatic crash. It arrived quietly. Factories slowed before they closed. Investment drifted before it fled. Talent looked outward before voters felt the consequences. A continent can remain comfortable while its economic gravity shifts away. How did two economies that face the same shocks end up on such different paths? Was this bad luck, or the delayed cost of choices made to protect stability? And if decline can unfold without chaos, how far can it go before it becomes impossible to reverse? To answer that, the story must start with the foundations of the European model and the trade-offs built into it. To understand why Europe fell behind without collapsing, it is necessary to clarify what economic decline looks like in advanced economies. Decline is often imagined as sudden failure marked by unemployment, unrest, and institutional breakdown. Europe experienced none of this. Instead, it entered a prolonged period of stagnation in which stability was preserved while momentum faded. Output continued to grow, but slowly. Productivity weakened. The ability to absorb shocks narrowed, even as daily life appeared unchanged. After the global financial crisis, European policy choices were shaped by a central priority. Social cohesion came first. Governments protected employment, expanded welfare buffers, and softened price shocks through regulation and fiscal support. These measures succeeded in preventing deep social disruption, but they also raised the cost of adjustment. When economies shield existing structures for too long, resources move more slowly toward new sources of growth. Productivity sits at the core of this trade-off. Productivity measures how much value an economy produces for each unit of labor and capital. It does not always show up immediately in wages or employment figures, but over time it determines whether incomes can rise without inflation. In Europe, productivity growth slowed markedly after 2008. As productivity stalled, growth increasingly relied on redistribution rather than expansion, placing pressure on public finances and private investment. Energy is another foundational concept. Modern economies depend on abundant and reliable power. When energy prices rise or become volatile, firms do not necessarily fail at once. They delay investment, reduce capacity, or relocate incrementally. These decisions accumulate quietly and reshape industrial geography without triggering visible crisis. Energy costs therefore act as a slow-moving constraint rather than an immediate shock. Demographics further tighten this constraint. Europe is aging faster than other major economic regions. Falling birth rates and rising life expectancy mean fewer workers supporting more retirees. Most European pension systems operate on a pay-as-you-go basis, where current workers fund current retirees. This structure works only when the workforce is stable or growing. When it shrinks, pressure builds through higher taxes, increased borrowing, or reduced benefits. Capital flows reveal how these forces interact. Capital is sensitive to expectations of growth, scale, and liquidity. When returns appear limited, investment moves elsewhere long before distress becomes visible to households. These movements are quiet, occurring through portfolio allocations and corporate decisions rather than public announcements. Finally, Europe's institutional design matters. Monetary policy is centralized, while fiscal responsibility remains largely national. This limits the speed and scope of adjustment. Governments must absorb shocks with constrained tools, often favoring delay over disruption. In a stable world, this design works well. In a rapidly changing one, it can slow necessary adaptation. With these concepts in place, the analysis can now turn to the structural causes that transformed cautious policy choices into long-term economic constraints. For decades, Europe's industrial strength rested on a condition that was rarely questioned. Energy had to be affordable, predictable, and continuously available. Heavy manufacturing depends on stable power more than almost any other input. When energy costs are low and reliable, factories can plan investment years ahead and compete globally on both price and quality. Germany became the clearest expression of this model. Its economy was anchored in chemicals, machinery, automobiles, and advanced manufacturing, sectors where energy prices directly determine competitiveness. For years, the arrangement appeared sound. Long-term supply contracts kept costs stable. Exports flowed. Employment remained high. The system was not reckless. It was rational within the conditions that existed at the time. The vulnerability emerged through sequencing rather than neglect. After the Fukushima disaster, several European governments accelerated plans to phase out nuclear power. The decision reflected public opinion and environmental priorities. Nuclear energy was increasingly framed as incompatible with a sustainable future. Renewables were expected to scale rapidly, while natural gas would act as a transitional fuel to balance intermittent wind and solar generation. This structure depended on stability. Renewable output remained variable. Gas filled the gaps. Industry absorbed moderate price increases in exchange for predictability. When gas supplies were disrupted and prices surged, the balance collapsed. According to analysis from Bruegel using Eurostat data, during the early years of the energy shock, European industrial electricity prices were more than 150% higher than those in the United States, while natural gas prices for industry were more than 300% higher. In the same period, American producers benefited from abundant domestic supply and far lower volatility. For industry, volatility proved as damaging as high prices. When future energy costs cannot be estimated with confidence, long-term investment becomes difficult to justify. Firms respond cautiously. Expansion is delayed. New capacity is built elsewhere. These decisions do not require public announcements. They are made quietly, guided by balance sheets rather than political debate. The adjustment unfolded gradually. Production lines were scaled back before they were shut down. Capital expenditure shifted before employment fell. Over time, capacity moved toward regions with cheaper and more stable energy. This did not represent an immediate collapse of European industry. It marked a steady erosion of its competitive margin. What made the shock more costly was limited flexibility. The loss of existing baseload capacity and restrictions on domestic energy expansion reduced options at precisely the moment they were needed most. As other economies expanded supply to stabilize prices, Europe relied increasingly on imported energy at elevated cost. The gap widened not because European firms became less capable, but because their cost structure changed faster than their operating models could adapt. Energy policy did not dismantle Europe's industrial base overnight. It revealed how narrow the margin had become between competitiveness and retreat. Once that margin disappeared, industry followed incentives rather than tradition. Regions built around manufacturing began to thin, not through sudden failure, but through cumulative decisions made over several years. As rising energy costs reshaped industrial behavior, another pressure intensified beneath the surface. The workforce supporting these industries was shrinking, and the fiscal systems built around it were already under strain. Long before energy prices surged and industrial competitiveness weakened, Europe was already moving toward a demographic constraint that would shape every other policy choice. Birth rates had been declining for decades while life expectancy continued to rise. At first, the imbalance appeared manageable. The workforce remained large enough. Public finances absorbed the cost gradually. Over time, however, the arithmetic became unavoidable. Italy provides one of the clearest illustrations. According to data from Italy's National Statistics Institute and reporting by major international outlets, the country recorded roughly 370,000 births in 2024, the lowest figure since national unification. Over the same period, the total fertility rate fell to about 1.18 children per woman. A modern economy requires a rate of roughly 2.1 to replace its population. Levels below 1.5 are widely considered a demographic emergency. Italy has remained below that threshold for years. This shift did not cause immediate crisis. Schools did not close overnight. Labor markets did not seize up. But each year, Fewer young workers entered the economy, while the number of retirees continued to rise. The pressure accumulated quietly, embedded in budgets and payroll systems rather than headlines. Most European pension systems operate on a pay-as-you-go structure. Current workers finance current retirees, with the expectation that future workers will do the same. This model functions when the workforce is expanding or at least stable. When it shrinks, each remaining worker carries a heavier load. Contribution rates rise. Net wages stagnate. Confidence in the system weakens. The effects extend well beyond pensions. Higher payroll taxes raise the cost of labor, discouraging hiring and investment. Younger workers face slower wage growth while shouldering rising tax pressure. Housing costs continue to increase faster than incomes, particularly in major cities. These forces interact. Economic insecurity delays family formation, which further reduces future labor supply. What begins as a demographic trend becomes a self-reinforcing economic constraint. Immigration is often presented as a solution, but its impact is frequently overstated. While migration can ease labor shortages, it does not immediately resolve fiscal pressure. New arrivals require time to integrate into labor markets and contribute at scale. When growth is weak and labor markets are rigid, the fiscal payoff arrives slowly, while political resistance builds quickly. As debates over immigration harden, policy responses stall. The political consequences of aging deepen the challenge. Older populations vote at higher rates and tend to prioritize the protection of existing benefits. Younger voters, fewer in number, struggle to influence policy even as their long-term prospects weaken. Governments respond by borrowing to bridge funding gaps, postponing reforms that carry immediate political costs. Debt rises, but the demographic imbalance remains intact. Demographics did not cause Europe's economic slowdown on their own, but they magnified every other shock. They reduced flexibility, raised structural costs, and narrowed the range of viable policy options. As energy costs increased and global competition intensified, Europe entered this period with a shrinking workforce and expanding obligations. The margin for adjustment was already thin. As demographic pressure tightened around labor markets and public finances, another signal became increasingly clear. Capital began to move, not in response to visible collapse, but in anticipation of slower growth ahead. When labor becomes scarcer and costs rise, economies depend on capital to raise productivity and sustain growth. In Europe, this mechanism weakened over time. Capital did not disappear, it relocated. European households have historically favored low-risk savings. A large share of private wealth has been held in bank deposits, government bonds, and residential property rather than equities. This preference reduced volatility for families, but it also constrained the supply of risk capital available to firms. Compared with the United States, where equity ownership is far more widespread, either directly or through retirement accounts, European participation in stock markets remains significantly lower. This behavioral pattern is reinforced by market structure. Europe does not operate a single, unified capital market. Legal systems, tax regimes, bankruptcy rules, and supervisory frameworks differ across countries. For companies seeking to expand across borders, each new market introduces friction and cost. What appears as one large market in theory functions as many smaller ones in practice. Scaling becomes slower, more expensive, and more uncertain. As firms mature, incentives shift. When companies seek deep liquidity, higher valuations, and access to global investors, they increasingly look beyond domestic exchanges. This trend is visible in public listings, venture funding rounds, and mergers. The choice is rarely ideological. It reflects market depth. Larger financial centers offer more capital, greater tolerance for risk, and more flexible exit options. Institutional investors follow the same logic. Pension funds and insurance companies are bound by long-term obligations. They prioritize returns, liquidity, and diversification. When domestic markets underperform, portfolios tilt outward. European savings are increasingly invested in foreign equities and funds, particularly in the United States. Capital generated in Europe finances growth elsewhere, often in sectors where European firms struggle to compete. The consequences extend beyond financial flows. Ownership shapes strategy. When shareholder bases and listings shift abroad, investment priorities often follow. Research centers relocate. Decision-making moves closer to capital markets. Local ecosystems lose anchor firms that once supported suppliers, skilled labor, and regional innovation. These changes do not occur abruptly. They accumulate through many small decisions made over time. Capital flight is often described as a reaction to crisis. In reality, it is usually anticipatory. Money moves in response to expected returns, not visible failure. By the time factories reduce output or wages stagnate, capital has already repositioned. This makes capital flows one of the earliest indicators of structural slowdown. As financial resources became less willing to absorb risk at home, Europe's growth model grew increasingly reliant on redistribution rather than expansion. Social systems built during periods of stronger growth faced rising pressure without the investment needed to offset it. With capital less able or less willing to scale domestic opportunity, the final question within the chain of causes emerges. Why did innovation fail to compensate for rising costs, demographic pressure, and mobile capital? Europe did not lose its capacity to innovate. Its universities remained globally competitive. Public research funding stayed substantial. Engineers and scientists continued to rank among the best trained in the world. New firms were founded across major cities. What weakened was not creativity, but the ability to transform innovation into sustained economic power at scale. In the modern economy, innovation generates growth only when it reaches large, unified markets. Digital platforms become more valuable as user bases expand. Artificial intelligence improves as capital, data, and computing power accumulate. Advanced manufacturing requires heavy upfront investment long before profits appear. In these sectors, scale is not an advantage. It is a threshold. Europe's internal market is large on paper, but fragmented in practice. Language differences, national legal systems, labor rules, and tax regimes continue to vary across borders. Each expansion into a new country introduces additional compliance costs and operational friction. For early-stage firms, this fragmentation creates a ceiling. Many reach national success but struggle to expand further before resources are depleted. Capital constraints reinforce this limit. As shown in the previous chapter, deep pools of risk capital are harder to access within Europe than in the United States. Venture funding rounds are smaller. Exit options are narrower. Firms face pressure to sell early or relocate once growth demands exceed domestic financing capacity. Innovation generates value, but that value is frequently realized elsewhere. Regulation further shapes outcomes. European rules are often designed to govern large incumbents, yet they apply to firms well before scale is achieved. Compliance burdens weigh more heavily on smaller companies, diverting management time and capital away from expansion. Instead of disciplining dominant platforms, regulation can entrench them by raising barriers to entry for challengers that have not yet reached size. Cultural incentives also matter. Failure carries higher personal and financial costs in Europe than in more risk-tolerant systems. Bankruptcy procedures are stricter. Labor protections increase the cost of restructuring. These features protect workers and social stability, but they also reduce tolerance for experimentation. Over time, incentives favor caution over ambition. Innovation becomes incremental rather than transformative. The outcome is not technological absence, but technological imbalance. Europe contributes research, talent, and early-stage innovation to the global economy while capturing a declining share of value created at scale. Few new growth platforms emerge that are large enough to offset rising energy costs, demographic pressure, and capital outflows. This failure to scale innovation completes the chain formed by the previous structural causes. Rising production costs weakened industry. Demographic pressure raised fiscal burdens. Capital moved toward deeper markets. Without large-scale innovation to reverse these trends, growth increasingly relies on redistribution rather than expansion, deepening the constraints innovation was meant to relieve. With all four structural causes now established, the pattern is complete. Europe faced the same global shocks as other major economies, but its system responded differently. To understand the consequences of those differences, the analysis must now turn outward. With all four structural causes in view, Europe's trajectory becomes clearer when placed alongside other major economies that face the same global shocks. The global financial crisis, the pandemic, energy disruption, and geopolitical fragmentation affected every advanced economy. What differed was not exposure, but response. The United States adjusted through speed and scale. Capital markets remained unified and highly liquid, allowing investment to rebound quickly after shocks. Domestic energy production expanded sharply during the shale revolution, keeping industrial power costs structurally lower and more predictable. Labor markets reallocated resources rapidly toward new sectors. These adjustments were often disruptive in the short term, but they restored momentum. Between 2008 and 2023, American output expanded dramatically, while productivity growth tended to recover more strongly than in Europe. China followed a different path. Adjustment came through coordination and concentration. State direction mobilized capital and labor towards strategic industries regardless of short-term efficiency. Energy policy prioritized reliability over cost. Scale was achieved rapidly, even as debt levels rose and inefficiencies accumulated. This model carried long-term risks, but it produced growth engines large enough to reshape global supply chains and technology markets. Europe's response emphasized protection. Employment was stabilized, welfare systems were preserved, energy costs were cushioned for households through subsidies, but transmitted to industry. These measures reduced immediate hardship, but they slowed reallocation. Capital flowed outward instead of being redeployed internally. Innovation struggled to reach scale. Over time, this dampened the formation of new growth sectors capable of offsetting structural pressures. The economic consequences are now visible across regions. Industrial capacity has thinned without collapsing. Manufacturing employment has declined gradually rather than abruptly. Younger workers face narrower career ladders and increasingly seek opportunities abroad. Public finances tighten as aging populations draw more support from a shrinking tax base. Political systems strain under the weight of rising expectations and constrained resources. The strategic consequences run deeper. As technology platforms, capital markets, and defense production concentrate elsewhere, Europe becomes more dependent on external systems. Decisions made in foreign financial centers and corporate headquarters increasingly shape outcomes at home. Policy autonomy narrows not through loss of sovereignty, but through loss of capacity. None of this constitutes sudden failure. Institutions continue to function. Daily life remains orderly. But the margin for error has shrunk. When growth slows and options narrow, the ability to absorb future shocks weakens. What once could be managed gradually becomes increasingly difficult to control. These consequences lead directly to the final question. With constraints tightening and momentum fading, what paths remain open to Europe, and what costs will each require? Europe still retains economic capacity, but the space for gradual adjustment is narrowing. Any realistic path forward must operate within constraints that are already binding. Demographic trends will not reverse quickly. Energy costs are likely to remain structurally higher than those of major competitors without major policy shifts. Capital will continue to move toward markets that offer scale and liquidity. Political authority will remain divided across national systems. Solutions, therefore, cannot promise a return to past dominance. They can only determine how adjustment unfolds. One possible path is managed decline. Under this scenario, Europe continues to prioritize social cohesion and environmental commitments while accepting slower growth as the trade-off. Public spending remains high relative to output. Taxes rise incrementally to finance pensions, healthcare, and energy support. Energy policy maintains its emphasis on emissions reduction even when industrial costs remain elevated. Innovation continues, but largely within regulated or specialized niches rather than global platforms. Living standards erode slowly rather than abruptly. This path avoids crisis, but it also locks in reduced competitiveness and long-term dependence on external growth engines. The alternative path is a forced reset. This outcome rarely emerges from consensus. It is triggered by pressure, a prolonged energy shock, a fiscal stress event, or a geopolitical rupture could compress years of delayed reform into a short period. Under such conditions, policy priorities would shift from protection toward capacity. Energy strategy would rebalance toward reliability alongside sustainability, including renewed consideration of nuclear generation where politically feasible. Capital markets would move closer to integration to mobilize domestic savings at scale rather than exporting them abroad. Pension systems would be adjusted to reflect demographic reality through higher retirement ages, revised benefit formulas, or both. Investment priorities would also need to change. Public and private spending on research and development in the European Union has hovered around 2.2% of gross domestic product in recent years, below levels observed in the most dynamic innovation centers. Raising this share would not guarantee success, but failing to do so would make further erosion likely. Labor markets would need to support mobility and retraining without abandoning protection, a balance that is politically difficult but economically necessary. Immigration would remain part of the adjustment, but not a substitute for growth. Targeted migration aligned with labor shortages can ease pressure in specific sectors, yet it cannot compensate for weak productivity growth or persistent capital outflows. Without expanding output and opportunity, migration redistributes strain rather than resolving it. The central distinction between these paths lies in timing and agency. Managed decline spreads costs across decades and reduces visible disruption, but leaves little room for recovery. A forced reset concentrates pain, yet it can restore momentum if reforms are credible and coordinated. History suggests that systems rarely choose deep reform early. They tend to move only when constraints become unavoidable. The remaining question is not whether Europe will change, but how and under what conditions. Adjustment before crisis preserves choice. Adjustment after crisis reduces it. And that brings the story to its final point, because the real danger is not what Europe has already lost, but what it may lose without noticing. Europe's experience over the past 15 years is often misunderstood because it lacks a single dramatic moment of failure. There was no sudden collapse, no breakdown of institutions, and no point at which daily life visibly fell apart. What unfolded instead was a gradual divergence between a system designed for stability and a global economy that increasingly rewarded speed, scale, and flexibility. The continent succeeded in protecting its citizens. Social cohesion endured. Public services continued to function. These were real achievements, not illusions. But they came with trade-offs that accumulated quietly. Energy grew more expensive without forcing immediate reckoning. Demographic pressures intensified year by year. Capital shifted toward deeper markets long before households felt the effects. Innovation continued, yet rarely reached the scale required to offset these structural forces. None of this was accidental. The outcome followed incentives. Policies rewarded continuity, risk avoidance, and protection of existing arrangements. For a long time, those incentives worked. They reduced volatility and prevented crisis. But as external conditions changed, the same incentives slowed adaptation. Stability moved from being a buffer against shocks to a barrier against renewal. The lesson is not that Europe chose wrongly, but that no economic model remains optimal forever. Economic strength is not guaranteed by history, institutions, or good intentions. It must be renewed continuously as conditions evolve. When renewal is delayed, change does not disappear. It arrives later with fewer options and higher costs. This lesson extends beyond Europe. Any society that assumes past success will persist without recalibration faces the same risk. Decline does not always arrive with chaos. It often advances quietly, sheltered by comfort and familiarity, until the margin for choice has narrowed. Understanding these dynamics matters because awareness shapes agency. When change is recognized early, it can be guided. When it is recognized late, it is imposed. The difference determines whether adjustment preserves autonomy or erodes it. If you want to continue exploring how economic systems evolve under pressure, how incentives shape long-term outcomes, and how slow structural shifts produce lasting consequences, consider following the channel and joining the discussion. The future is not predetermined, but it is shaped by whether societies are willing to confront constraints before they become unavoidable.